Today is July 1st, 2016, and this is the ADM Investor Services Weekly Market Review. Happy Friday to you both. Today's guests are Steve Freed, VP of Grain Research here at ADMIS, and David Hightower, President of the Hightower Report. Dave, what is Brexit and how did it affect global stock, currency, and commodity prices?
Well, Brexit is the decision by the UK to begin to sever relationships with the EU, trade, political, currency, some of which they had not quite reached a full integration on. But I think it's a slow motion crash. It's going to add some fresh headwinds to the economy and to the markets, but probably not a long-term major negative.
And what is the long-range impact Brexit could have on these markets?
Well, I think the fear is that other countries would take the same track, and then if you lose viability of the Eurozone, then all of a sudden we have a chaos and a big event that lasts for quarters on end.
What markets are you looking at that could go higher or lower from here?
Well, I don't want to sound like a techie guy, but if you look this week and you see that the commodities that start with S, sugar, silver, soybeans, they're showing outsized gains. Now, a fundamental or economic justification is those are very heavy, physical, widely traded commodities. And so now we're starting to see some price appreciation, and the treasury market has exploded. The gold market has exploded. So if I didn't know any better, if I didn't realize that there's no chance of inflation, I would say it looks like there's inflation coming to me.
What is going on in the cattle and hog markets, and where are they going?
Well, I think that we are, especially yesterday when we saw a sharp break in corn prices, we saw the potential now for feed demand to pick up and for us to finally start to expand the cow herd. So hogs have been pretty much leading for most of this year, but now the cattle market might be the late horse, so to speak.
And you were recently in Ukraine. What was your impression?
Well, I mean, there's in one part they're still somewhat like the former Soviet. At some points you feel like you're back in the 1950s, but I can also, by the amount of people that I met at this conference, realize that their ag sector is really going to be a player in the world market. I mean, they're at any given time their third or fourth largest exporter, and really they are going to have an outsized effect on the corn market going forward, just because they'll never probably consume that much inside the country. So it's a positive.
All right. Steve, the USDA had a big report Thursday. What did they say?
USDA reports have in the past had some pretty big surprises and pretty big market reaction, and yesterday was no exception. While they came out and showed increase in soybean acres from their March intentions, it was not as big of an increase as the bears had hoped for. So we had a pretty positive price reaction to soybeans. And it puts a lot more emphasis on weather to make sure that we get the yields, to make sure that the carryouts don't go down. They said that the June 1 soybean stocks were a little bit higher than the average guess. So you have this battle going on with analysts saying, well, should this year's carryout go up because they understated last year's crop? Or should it go down because most commercials think the demand is going to be bigger than what they're saying? And if we look forward to 16 and 17, commercials feel the demand is higher than what the USDA is saying. And some people have a carryout as low as 150 million bushels for next year for beans versus the government's 260. And analysts afterwards said we may need to go to $13 beans at some point in time, maybe after harvest, in order to show this increase in demand. Now the opposite was true in corn and wheat. They basically said there was a little bit more corn acres than the trade had thought. June 1 stocks were bigger, and so it looks like the carryout in corn is going to be bigger unless there's a weather problem. So you could see actually corn prices drift lower because of this higher supply. They also said that there's plenty of wheat out there, and as we get through more of our harvest and look at the spring wheat crops, last week the Canadians were talking about having a record wheat crop. There's no real problems with wheat, and so you can see wheat prices go lower. So I mean, the most important thing that I think that we came out of this report is that if money comes in on the long side in the grain markets, It might be on the soybean sector, and if they might hedge themselves against a short corn and wheat position.
And something I might add is that when you take the psychology we had in place at the beginning of the year, it was all negative all the time. We had such a historical ending stocks fear that this report cleans that up. So we took the worst case market, which was soybeans, and have now changed it enough to where we don't have to fear this major long-term bear market in grain prices, just because the one that could have been the most oversupplied is now going to find it difficult to do that.
Please remember that the opinions expressed here today are solely the opinions of our guests and are not necessarily the opinions of ADM Investor Services or Archer Daniels Midland Company. If you have any questions or comments or would like to know more about our services, please contact us at www.admis.com.